Welcome to Module 7 of the TaxSlayer Pro Basic Income Tax Preparation course. In this module, we'll discuss income, Part 5. We'll go over the Schedule E, including the K-1, depreciation, and rental property. First, let's talk about the K-1s. Schedule K-1 reports a taxpayer's share of income and other distributions, deductions, and credits from partnerships, which are reported on Form 1065, S corporations, 1120S, and some estates and trusts, reported on Form 1041. Here's a typical Schedule K-1 from an 1120S showing ordinary business income in Box 1, interest income in Box 4, and the shareholder's percentage of stock ownership in Box F. Partnerships, S corporations, estates, and trusts are often called pass-through entities. This means these entities aren't subject to income tax. Instead, the owners are directly taxed individually on the income, taking into account their share of the profits and losses. In other words, the income passes through these entities directly to the owners and shareholders. Schedule K-1 income can include interest income, dividend income, net short-term capital gains and losses, net long-term capital gains and losses, tax-exempt interest income, royalty income, reported on Schedule E, and Schedule E is used to report income or loss from these partnerships, S corporations, as well as estates and trusts. Next, let's look at rental income, reported on Schedule E. The dictionary definition of rental income is any payment that you receive or the taxpayer receives for the use or occupation of property, and generally must be included in gross income on the tax return. In addition to amounts received as normal rent payments, there are other amounts that may be considered rental income. Payment for canceling a lease, expenses paid by a tenant, advance rent, and you report advance rent in the year that you receive it. Security deposits. Do not include security deposits in income if you plan to return it at the end of the lease. If you keep it, you include the security deposit in your income for that year. If you rent property that you also use as your home and you rent it fewer than 15 days during the tax year, do not include the rent you receive in your income and do not deduct rental expenses. We have a little event here in my hometown every April where some of us are fortunate enough to rent our homes out for the week. And again, we don't include the rent we receive in income and we don't deduct any rental expenses. As far as rental expenses, you deduct rental expenses in the year that you pay them. For vacant rental property, you can deduct ordinary and necessary expenses from maintaining the property while it's vacant. However, you can't deduct any loss of rental income for the period that the property is vacant. So when can you start claiming expenses for your rental property? From the time that you make it available for rent. Uncollected rent, again, you do not report uncollected rent because you don't include it in income, you can't deduct it. So what are some of the more common deductible rental expenses? Mortgage interest, property taxes, property insurance, auto and travel expenses related to the production of rental income and the standard mileage rate, 54.5 cents per mile. Property repairs. You can deduct the cost of repairs to your rental property. you can't deduct the cost of improvements. You recover the cost of improvements by taking what's known as depreciation. Repairs keep your property in good operating condition. They do not materially add to the value of the property or substantially prolong its life. Improvements add to the value of the property. They prolong the property's life or adapt it to new uses. Some examples: adding a rec room, adding a bath or a bedroom, putting up a fence, putting on a new roof, new cabinets, paving a driveway. Other expenses you can deduct from your rental income include advertising, cleaning and maintenance services, utilities, commissions for the collection of rent. Now let's talk about depreciation. You recover your cost in income-producing property, in this case rental property, through yearly tax deductions. You do this by depreciating the property. That is, by deducting some of your cost basis, on your tax return each year. Generally, you use Form 4562 to calculate and report depreciation on your tax return. Three basic factors determine how much depreciation you can deduct: your basis in the property, the recovery period, which is how long you're able to depreciate the property, and what's known as the depreciation method. So what are some examples of depreciable property? Buildings, machinery, furniture, vehicles, improvements made to rental property. So what do we mean when we say depreciation methods? Well, the Modified Accelerated Cost Recovery System, most often pronounced MACRS, is one of the methods. Began in 1986. There's ACRS, Accelerated Cost Recovery System, and this is for property that's placed in service after 1980 but before 1987. And there's straight line depreciation. Most business and investment property placed in service after 1986 is depreciated using the MACRS tables. And like we said earlier, to figure your MACRS deduction, you need to know the recovery period, placed in service date, and a depreciable basis. Below are some examples of recovery periods. In other words, how many years the item can be depreciated for property used in rental activities. Computers, 5 years. Automobiles, 5 years. Appliances and furniture, 5 years. Shrubbery and fences, 15 years. And the building itself, the residential rental property itself, 27.5 years. Additions and improvements, such as a new roof, are also 27.5 years, or the same recovery period as that of the property to which the addition or improvement is made. You can begin to depreciate property when you place it in service in order to produce income. This is the placed in service date. Rental property is considered placed in service when it's ready and available for use. The basis used for figuring depreciation is your original basis in the property increased by any additions or improvements. Your original basis is usually your cost. But you must subtract the value of land before arriving at the basis for a rental house. Rule of thumb here for the value of a lot, 10% of the total value of the home. For example, a home purchased for $200,000 would have a basis for depreciation of $180,000. We calculate depreciation expense by using depreciation tables. Now, without getting too far down in the weeds, just want to talk about a little sidebar on depreciation, the half-year convention. For most depreciable property other than real estate, a half-year convention must be used. Now, this means that no matter what month of the year you begin using the property, the depreciable property, you must treat it as if you began its use in the middle of the year. So you'll generally get 1/2 of the first year's depreciation regardless of when you placed the property in service. This is the half-year convention. Now you may also hear the term somewhere down the line, the mid-quarter convention. There's an important exception to the half-year convention that we just went over. If Uncle Sam were going to give you a half-year's tax break for a purchase made any time in the year, then what would keep you from routinely purchasing all your business assets and placing them in use or in service in the final days of December? Well, that would allow you to get a deduction for a half year's worth of depreciation while avoiding any actual cash outlay for your depreciable assets until late in the year. Good deal? You bet it is. But unfortunately, the IRS is aware of this strategy, and they've imposed what they call the mid-quarter convention rules to prevent you from doing just this. These rules, again, called the mid-quarter convention rules, apply if you place more than 40% of your total new property for the year into service in the last quarter of the year. If you do, you'll have to use these rules for all assets placed in service during the year. Under the mid-quarter rules, assets are considered to be placed in service at the midpoint of the quarter in which they were actually placed in service. Okay, let's get away from that. Let's see how we use the depreciation tables. Now, Harley Drew purchased a rental house on January the 10th, 2017. The house was in great shape and was ready to rent the next day. After subtracting the value of the land, the cost basis of the house was determined to be $160,000. So how much depreciation is Mr. Drew able to subtract from his rental income on his 2018 tax return? Well, the house was placed in service in January. We're in year 2, so we're going to use 3.636 as our depreciable percentage. Now, if you've got tax software, you don't have to worry about doing hand calculations. I just want to show you where these numbers are coming from, how the depreciation tables are used. So $160,000, value of the house, times 3.636% from the table equals $5,818. So that's his depreciation on the house. He also purchased a side-by-side refrigerator from Home Depot for $1,200 on January the 12th, 2017 for use in his rental house. How much depreciation can he deduct because of the refrigerator purchase? Well, we're in year 2. We're using that half-year convention that we talked about. So we're going to multiply by 32%. $1,200 cost of the refrigerator times 32%, $384 depreciation for his 2018 tax return. Now, he rented the home to a college professor for the entire year of 2018. Now, because Harley's such a nice guy, he only charged $1,200 a month rent. If Mr. Drew has no other expenses associated with the rental property, then how much income does he have to report on his Schedule E and eventually on his 1040 for the year 2018 from the rental property? Well, his total amount of rent received, $1,200 a month times 12 months, $14,400, minus $5,818, the depreciation from the house itself, minus $384, the depreciation expense from the refrigerator. The total amount of rental income that he reports, $8,198. Now, the total amount of depreciation gets reported on Form 4562. 6202 on line 17 is the total depreciation of the house and the refrigerator. We look at Schedule E, reporting the rental income. And as we said from the example slide, he reports $81.98 on his tax return. This Schedule E rental income transfers to line 17 of the new Schedule 1, Form 1040, and eventually flows to line 6 of the Form 1040 itself. Now, renting out real estate property generally is considered a passive activity, even if you devote a substantial amount of time to selecting the correct tenants, repairing the rental unit, and inspecting the property for routine maintenance. So what this means is that the IRS limits your losses from your rental business, if any, to a maximum of $25,000 per year. This is $25,000 in total losses from all of your rental properties if you happen to own more than one. Let's look at an example. Buzz Aldrin is retired, but in his spare time he maintains 5 rental houses. He rented each house for $1,000 per month, and he was fortunate enough to keep them rented all year long. So his income from all the rental properties was $60,000. However, when he subtracted his expenses, his repairs, and depreciation on all of the properties, he showed on paper a $28,200 loss from the rental properties. He's only allowed to subtract $25,000 of the $28,200 loss this year, but he'll get to carry over the extra $3,200 to next year's tax return. So here's what we see on Schedule 1, line 17. That loss is limited to $25,000. And on the 1040, that amount flows to line 6. The rental loss carryovers are shown on Form 8582. And here's an example of the Form 8582 for our client, Buzz Aldrin, and we see that on the form, the rental loss is limited to the $25,000 for 2018. The 8582 also shows the rental losses that will carry forward to next year's tax return in the unallowed loss column. Now there's a magical disappearing deduction. Income levels can limit rental losses, and they work like this. If your modified adjusted gross income, or what we call the MAGI, is less than $100,000, you can deduct up to that $25,000 in what we call passive rental losses against non-passive income. If your modified adjusted gross income is over $100,000, then your maximum loss available is decreased by 50 cents for every dollar over the $100,000. The maximum loss is completely phased out at $150,000 in income. So what happens if Mr. Aldrin made $150,000 on his 2018 W-2? How's that going to affect his rental property loss on his 1040? Well, let's take a look. On the 8582 now shows an unallowed loss of $28,200 that will carry forward. And on the 1040, because of his higher income, Mr. Aldrin cannot show any loss at all on his 2018 tax return for his rental property. The loss will be carried over to his 2019 tax return. So in summary, a Schedule K-1 is used to report income and deductions from an S corporation, a partnership, or an estate. The K-1 is then reported on Schedule E. S corporations, partnerships, and estates are sometimes referred to as pass-through entities. Income passes through each of these entities and is distributed to the individual taxpayers. Income and deductions from rental property are reported on Schedule E. If you rent your home for fewer than 15 days, do not report the income or the expenses. Recover the cost of improvements to rental property by taking a depreciation deduction. And the IRS limits losses from rental property to a maximum of $25,000 per year. Unallowed rental losses are shown on Form 8582 and are carried forward to the next year's tax return. And now let's take a look at a few review questions.